Amazon kicked off February with impressive fourth quarter numbers. Strong e-commerce performance during the holiday season, continued AWS cloud dominance, and healthy advertising revenue growth. But the market zeroed in on two concerns: disappointing guidance for 2025 and a massive $1 billion AI investment. In the wake of the DeepSeek developments, investors questioned this substantial spending, particularly as growth moderates and competition intensifies. The reaction was swift. Amazon shares have dropped 8% since the earnings release. Yet the macro picture tells a different story. IQ's analysis reveals improving conditions, with model value climbing 2% since the announcement. This divergence has created an opportunity. Amazon now trades 9.1% below where macro conditions suggest it should be, and that's triggered a bullish signal. Last week's headlines brought another twist. Walmart issued cautious forecast for the year ahead, citing government policy shifts, namely Trump's tariffs and Doge's job cuts, that could dampen consumer spending. Some might see these warnings about US consumer weakness as a reason to ignore the Amazon opportunity. And yes, there are seasonal headwinds. Late February, historically, sees US equities drift lower, but context is crucial. Look at Walmart's position. Their stock has surged 80% over the past year, pushing valuations 30% above long-term averages, the most extreme reading since 1999. Trading at 38 times forward earnings, Walmart's success story appears fully priced in. Amazon presents the inverse case. Current prices reflect considerable macro pessimism. For investors seeking strategic entry points, this disconnect between price and macro fundamentals offers an intriguing opportunity.